Hello, let us look at another element of the statement of the financial position, which is the liabilities. And let's first understand what is a liability. And a liability is a financial obligation that a business owes to another party due to past events which it will need to settle in the future. Okay, so note one, the business owes something to another party. Okay, and also note it is due to past events. These may arise either from borrowing. You borrowed some money either from the bank or from a friend or whoever you borrowed from. So this is what you're calling a past event, or rather a past transaction. Or you received some goods that you didn't pay for. So you are expected to pay these goods. So this is what we are calling due to past events. This transaction happened. That is why you have this financial obligation. And this you will need to settle in the future. So you should always know there's going to be an outflow of resources to settle this obligation. Okay, so basically a liability is the value the business must give up. Okay, it could be cash, whether you're paying loan in cash, it could be goods, it could be services. Okay, so as basically when you settle it, it is no longer a liability to the business. Okay, but as far much as where you sit as a calling it as a liability, it is the value the business must give up. Okay, so let us look at the classification of liabilities. So it's classified into two majorly, which is the current liabilities and the non-current liabilities. And current liabilities, basically these are liabilities that we expect that they will be settled within 1 year. Okay, within a period of 1 year, these liabilities will be settled. For example, let us look at example. Number one is the accounts payable. Accounts payable. This is basically where you bought some goods, you've not paid for them. Let's say you buy and you're in a business of buying and selling. So you owe some money to the people you bought from, that is your suppliers. So this is something you need to settle. No one expects, we expect a credit to businesses to be paid within a period of 1 year. Okay, so the first one is the account payable. Number two is bank overdraft. So for example, you need to settle something worth of 1.1 million, okay? And your bank has a balance of 1 million. The bank allows you to overdraw another 100K. So you're able to transfer this 1.1 million. So this 100,000, this is a liability that you need to settle with the bank. When you deposit the next time, they're going to actually cancel out that 100K to pay themselves that overdraft. Okay, then there is the accrued expenses. Accrued expenses, these are expenses that were incurred in the previous period that have not yet been sorted. Okay, and they are also expected to be settled within an year. Okay, another is a loan which is short term. Okay, so you have a loan that has the terms are pay maybe 3 months, 6 months, 9 months, or 12 months. Then that is a short-term loan, and it is also going to be classified as a current liability because it is something that we expect you to settle within 1 year. Okay, now let us look at non-current liabilities, which are also known as long-term liabilities. Long-term liabilities, and these are liabilities that are expected to be settled. You can settle them even after more than 1 year. Okay, so these are liabilities that might go all the way from 3 years, 4 years, depending, as long as it is more than 1 year. And the major example, the main common example is long-term loans. If you go take a loan of 5 years, you see this is a long-term loan. Okay, and there are many other forms of long-term loans. Could be mortgage also, could be mortgage. Okay, it's also a long-term loan. Okay, So this is basically the classification of liabilities. And when we are doing the statement of financial position, or rather the balance sheet, you should take note of this classification because we need to have the current liabilities and the non-current liabilities shown in that statement.